Welcome to Asian Investors Network, where we help our community prosper and achieve their financial goals. Let's begin. I'd like to cover a few topics in personal finance that I think are critical to improving your investment success. And the first thing I'd like to start with is just making a plan. Your financial goals might include getting out of debt, saving up to buy a house, retiring early, or building wealth. My personal goal when I was 17 was to reach financial freedom by the age of 30 by becoming a successful investor. I did some calculations back then, and I realized that I would need to earn a strong income and do very well in investing in order to achieve that goal. So for the next decade, I focused pretty hard on learning, building up my financial skills and investing. So to achieve your goal, you would need to plan it out and figure out how will you achieve the goal. How much money do you need to earn and save every month? Like how long will it take to pay off all of your debt or save up for your goal? And what can you do to get closer to your goals? I think finances are like any other subject. You can think about it like exercise. If you measure your results every week at the gym, you know whether you're making progress or not. You can develop different plans and strategies if you're not getting results. So if you want to improve, you have to put in the time and the work. You have to measure your progress and your results. If you measure it, you can improve it. But if you don't keep track, progress will be more difficult and random. The second topic I'd like to cover is how to have a shortcut to better success. And to me, that is surrounding yourself with successful people. I think that the greatest shortcut to success is to simply copy another successful system. It's true of any career path, and it's true for personal finance and investing as well. And later on, you'll have the chance to copy the career strategies of Max and Amy. So there's no real need to reinvent the wheel or go it alone here. You can really magnify your results and reduce the time it takes for you to improve if you learn from mentors and peers with a track record of success. It never hurts to ask for help, but people can only help you to the extent of their own understanding. So in other words, people are only qualified to give you advice on topics they understand. I always try to surround myself with people who are more successful than me so that I can learn from them. So participating in groups like AIN will help us to elevate each other for further success in our lives. On the other hand, if you're only surrounded by people who don't know what to do financially, it's going to be more difficult to find solutions. That's why it's important to surround yourself with successful people so that you can get better answers. If you have better solutions, you get better results. The third topic I like to cover is that it's not always about how much you earn, it's about how much you keep. That's the golden rule of personal finance. But even though people are aware of it, you don't always follow it. It's not your salary that will make you rich, but your spending habits. In other words, don't spend everything you earn, or you won't have any savings, no matter how much you earn. The correct way to measure wealth or financial success is net worth, which is simply assets minus liabilities. Assets are things that you own, and liabilities are things that you owe. So in other words, net worth is what you own minus what you owe. Very simple formula. Someone who earns, let's say, $55,000 a year and saves just $5,000 a year is actually doing better than someone who's making $100,000 a year but saves nothing. Or even worse, spends more than they actually earn in order to impress other people. Right? Over the years, that actually makes a big difference. Don't fall into the trap of looking rich. It's better to be actually rich. When someone earns a high income but never seems to have enough money or savings, the culprit is usually spending. Gaining wealth is actually a very similar formula. Spend less than you earn. Increase your income and invest your savings. That's all there is to it. The legendary investor and one of my favorites, Warren Buffett, recommends, don't save what is left after spending, but spend what is left after saving. That's called paying yourself first. Setting aside money and savings before you pay any bills. So what do you do with all those earnings? You invest often and early. Investing is often seen as a shortcut to wealth because it's efficient. Instead of working hard for your money, you can actually make your money work hard for you. And to be clear, just because you invest doesn't mean that you'll make money. In fact, you could very well lose it all if you're not investing in the right things. But just because there's risk doesn't mean that you should avoid it. Investments always comes with some form of risk. And part of our job as investors is to learn how to effectively manage and reduce those risks. The earlier you start investing, the more time you have for your investments to compound and work in your favor, and the more time you have to recover from any mistakes. The more you invest, the more capital you have to work with in the future. There's a financial concept called the rule of 72. The rule of 72 helps you quickly estimate how long it will take for an investment to double with compound interest. And the formula is this. It's very simple. Number of years multiplied by the interest rate equals approximately 72. So, for example, let's say that you invest a sum of money and you're earning 10% per year on that money every single year. The time that it will take for you to double that money is 7 years or 7.2 years. Let's say that you're earning 9% a year. It will take you 8 years to double your money. 9 times 8 equals 72. So this is useful as an estimate. You don't have to precisely reach the number 72, but it helps you quickly estimate what's going on in terms of how long it takes something to double. It means that you need to pay off your high interest rate debt as soon as possible because the amount doubles so quickly. For example, if you got credit card debt, that's usually in the teens, right? If not in the 20% and above. That's crazy because if you think of like just 20% interest, how long will that take to reach 72? Just a little bit over 3 years, right? So that's why high interest rate debt is so difficult, or payday loans or hard money is really difficult to work with. You have to have a plan in order to get rid of it. It also means that a low interest rate loan is not very threatening, right? All the savvy investors during the past few years have been loading up on as much debt as they could because it makes sense. It is helpful to have that sort of low leverage because a low interest rate doesn't really threaten you. If you're earning, if you're paying like say 3% on your loans, how long will it take to double? Pretty long time, right? 24 years. You have a lot of time for you to work in your favor. It also means that you should start investing as soon as possible because part of the equation is the number of years. The more years you're invested, the more time you have for your investments to double. That's the power of compound interest and the rule of 72. The next thing I'd like to talk about is risk. Investing isn't gambling or speculation. It's about taking calculated risks. Try not to throw away your hard-earned money because it's always easier to lose than it is to make money. When you're making money, you got to pay taxes. There's an element of uncertainty and so on. When you lose money, you just lose it, and you have to work harder to make it back. Informed investing is about taking calculated risks by logically evaluating an opportunity. You got to think about whether you understand it and whether it makes sense for your financial situation. When you understand the risk factors and how to mitigate them, it actually helps reduce your risk in that investment. So do your due diligence and evaluate each opportunity, and then make an informed decision on whether the risks are worth the rewards and whether it makes sense for your financial situation. One of the most important skills you can develop as a new investor is determining who and what you can trust. Bad advice is more damaging than good advice can be helpful. So avoid listening to the gamblers and learn from the successful investors with track records over time. There is 2 more topics I'd like to cover, and I'll do a recap. The first is probably the number 1 thing that would determine whether or not you're successful as an investor, and that is to master the human element. Investing based on emotions leads to losses or subpar returns. Your ability to reason and maintain control of your emotions directly leads to your investing performance over time. Your reasoning and control over fear and greed, in particular, will determine whether you're successful as an investor or not. So you have to be honest with yourself. Recognize if you're the emotional type. Like, for example, symptoms would be if you feel FOMO, like the fear of missing out. Like when you see people doubling their money all the time on crypto, are you tempted to join in even though you don't understand anything? That would be a symptom of FOMO. Do you feel high anxiety when you see that your portfolio value is going down? Like you check your stocks and then you feel like a sense of dread because the market's gone down. That could be a symptom of fear. If you jump into NFTs, or crypto without understanding it or what you're getting into, especially if it's based off of the advice of a Telegram chat group that you don't know anything about, that is a symptom of greed, right? This kind of behavior can result in losses, unfortunately. I have a friend who, didn't listen to some advice. I was telling him, look, don't go all into Luna like you've never invested before. But unfortunately, he went all in and he put his down payment for a house he was saving for in that investment. Unfortunately, he had to learn that lesson the hard way. Good news is he has a good attitude about it, and I believe that he can make it back. So if you're concerned about losses, make sure that you review your initial investment thesis and consider whether it still applies. This helps you determine whether you should take any action. Some factors you should consider are whether anything has changed materially. Is that valuation down simply due to effects or movements of the general market? And if your intended hold period is 5 to 10 years, does it really matter what the price does in the short run? And do you still have high conviction in your investment thesis? It's okay to be emotional, but recognize that you're more susceptible to losing money if you actively manage your investments. So if you're overly emotional, it might be better to either have a savvy investor invest it for you instead, or just put your funds in a low-cost index fund and leave it there. The last topic I want to cover is about dealing with losses, which I think is particularly relevant in this market. It's a pretty challenging market right now for most people, professional investors included. But there's a few realizations that can help you cope with the disappointment, the frustration, and the negative emotions of a loss. So in spite of your expectations, your hard work, and your time invested, not every investment will perform well. Investments inherently have some form of risk. So it's just a matter of how much risk you can mitigate or control. So examine what went wrong with your investment. Was it a failure of due diligence? Was there a problem with execution of the plan? Or was there some sort of faulty underlying assumption or market risk? Analyzing these details will help you prevent a loss in the future. Even if you experience a loss, as long as you learn from the mistake and experience and lower your risk of repeating the same performance, it's not the end of the world. Money can always be earned back. So if you can't do anything about it, then just let it go. Don't be a prisoner to things that you cannot change or control. And also, don't let a few bad results discourage you. If you keep losing, find out why and make some changes. Quitting the game means that you truly lose, and you lose the opportunity to gain wealth without having to work for it. That's the beauty of investing. You don't have to work particularly hard to make a lot of money. It's always better to make a mistake now with lower losses than later on when you're working with much larger sums of money. So don't, use money that you need for living expenses to invest. And think of it this way. Every dollar that you allocate to investments just stays in that category forever. That helps you separate the emotions and the pressing need for this kind of money. In closing, just want to sum up what we talked about today. When you're getting started investing, the first thing you should do is make a plan, what you want to achieve with your investing goals. Second thing to do is to surround yourself with successful people, mentors, people in AIN who can help you, groups, even channels and social media that can help you improve your results. And the next part is to recognize that it's not always about how much you earn, but it's also about how much you keep. It's very important to make a lot of income. That helps shortcut your road a lot. And you'll learn about that in the next sections. But you also have to keep that money. Don't just spend it all because you're making more. Next off is to invest often and early. The earlier you start and the more you do, the better your results will be over the long run. Remember, the rule of 72 is a shortcut to calculating how long it takes for something to double. And it's a good way to compare investments against each other. Next up is remembering that investing is all about taking calculated risks, making informed decisions, and reducing your risk factors. Finally, we have mastering your emotions, which is critical to investment success. When you can master the emotions of fear and greed and just become a robot like a Warren Buffett, Just stick to the formula and you're good. That kind of discipline is really hard to come by, because as you get more and more successful, more opportunities are presented to you and you have to evaluate more. Sticking to the plan is very helpful. And finally, dealing with losses, remember that everyone loses from time to time. There are no surefire winners all the time. Most important thing is to keep going and to get better and better.
Awesome. Thank you, Sam. And, Sam talked about, first having your plan. I'm very curious to hear about Max's plan and his talk on career development, as he has a very impressive track record. And we're going to get to that now. So Max began his career as the co-founder of a social commerce startup, which was acquired 1.5 years later. And during the next phase of his career, Max grew the Maps API business as an enterprise account executive at Google, securing the largest sale in North America in the Maps API business. Max currently serves as the head of sales and partnerships at Precisely, where he is responsible for strategic partnerships and sales. So Max, thanks for being here, and go ahead.
Thanks, Henry, and thanks, Sam. Appreciate you guys having me on. Sam, I really like how you talked about having kind of like goals in mind, because I think especially it's tough. I think especially like thinking back, in college, right, and even before college, it's hard to know what you want to do when you come out of college. Like, what is the working world like? I definitely had that, and to kind of share with you guys kind of like some stories and tying together, how, thinking about your career and thinking about goals. The time I graduated, that was during the financial crisis. So, Sam and I were same year graduation. It was a really tough year. I had, for a few years, thought I was going to go into consulting, and I studied, like all the case studies and went to all the networking sessions and I did everything right. But when the financial crisis came, it flipped everything on its head, because, instead of hiring, 9 or 10 people out of UCI, now they're hiring like 2 people. So, I thought, like I had this track in mind, I had this goal, and it completely just shattered my world, because after that, there was just no opportunities really left. And I think that's one thing to keep in mind, is that, when you have something in mind, there are going to be times when you're going to come across really difficult roadblocks and challenges. And it's important to kind of keep in mind, like stay true in terms of like what you want to do, and continue pursuing, other things that may be relevant, right? So during that time where it was really tough, I started looking at entrepreneurship, and I started I joined the Entrepreneur Society at UCI. I interned at a startup in the Bay Area, and then eventually I ran as a treasurer on Entrepreneur Society, where I was exposed to all kinds of CEOs, across different industries. Like the CEO of Yogurtland came to speak at UCI, CEO of In-N-Out, just a lot of really interesting perspectives. And that kind of helped broaden my my frame of thinking. Because in college, you have a few ways of, there's a few tracks, right? There's accounting, maybe there's, especially for economic major, there's probably finance, and finance is so complicated. I had no idea what finance really was, because it's just like, is it banking? Is it retail finance? It's all kinds of stuff, right? And I really gravitated towards entrepreneurship. From there, essentially, I one of my roommates introduced me to this really interesting character who, at the time, was looking to start a startup in Irvine. And this was back in 2009, before like startups were even sexy, right? This was like pre-Groupon days, even if the audience here knows what Groupon is. It's really back in the day where like startups wasn't really a thing. But I would say that like just stay and continue with your passion, right? And when things don't go your way, even if you have a plan, and it's important to have a plan, to think creatively, right? And to think about other ways to kind of continue exploring your talents, exploring what's around, what's available, right? Because there's always somebody who may have a really cool idea, who may know somebody that can help you, and reach out, right? And also kind of do the same as well. When people are going through a lot, they're struggling. If you can help them in any way, definitely try to be there for folks that you think you can help with. So I would say that would probably be the first thing. The second is around networking. And when I think about networking, I think about more as friendships, right? Throughout my career, even like the startup that I co-founded, I that was through a network. That was through my roommate who introduced me to somebody else. For Google, that was actually a referral. I was referred into Google from an old high school friend. For a Series A SaaS startup that I worked at, it was Lightspeed venture funded. That was through a previous COO of a company I worked at. And it's really, I think, as you kind of think about networking and think about the pressure of like, oh, how do I present myself, it's really just making friends, connecting with people that you have mutual shared connection, or some sort of shared interest. A lot of my friends that I made in college and outside of college, we have a lot of shared interests and common interests, and that definitely helps kind of create bonds. And from there, you're able to help each other. You're able to figure out, like, oh, I know this person that may be able to help you, or maybe talk to that person. I know Sam has introduced me to tons of people throughout my career as well. So, think about it as more as making friendships, rather than, trying to force yourself. If you do get nervous when you're doing networking and things like that, um, that may help a little bit there. That definitely has helped me in terms of my career. And then, and then the third point, I would say is focus on your speaking and writing skills. I think in terms of the most important skills when it comes to business is, number one, your speaking and how you communicate something. Number two is written communication, emails, sometimes documents, especially in a work environment, right? Those are going to be the two main components. Sometimes it's even more important than the content that is actually being communicated. So it's how you communicate sometimes can even be more important than what you communicate. So, in terms of any sort of kind of hard skills there, those are critical. And there are a lot of ways to kind of improve. Like for me, I was not a good speaker. I was not a good writer by any, yeah. So I see Toastmasters, that's great for that. I joined Toastmasters as well. And I joined late in my career. I'm in sales, and all I do is talk. But I joined Toastmasters like 2 years ago, and it still helped me. It still helped me tremendously, right? So if you think about, those skills, and one thing I want to add is also, if you think about how you want to improve those skills, it's really easy to practice too. Just practice at home. If you have something important like a presentation coming up, it's really cool to get in front of a mirror, see how you portray yourself, see how, take notes on what you say, write things down, jot things down, observe other really great speakers, see how they kind of portray their body language, how they communicate, and just keep practicing. And same with writing. Those are very helpful skills that you could easily level up without really, just taking time for yourself to practice. So, in conclusion, I would say A is, have a goal in mind, and don't worry if it doesn't go the way you plan, because you're going to be resourceful, you're going to be able to figure things out, and you have support, you have people to lean on, um, and keep chugging along. Number two is friendships and network, right? That's really critical. I think it's really important. At the end of the day, it's not about really how much money you make per se. It's more about the relationships and the people that you interact with, and how they perceive you at that end of engagement, right? That's more important, at least for me. And then number three is your speaking and writing skills. Those are critical in the business world.
Awesome. Thank you, Max. Yeah, I think it's really important just to keep your goal in mind and have it just centered in, and make sure you do things that are gonna help you get to that goal always, and try not to get distracted, because I feel like that's my problem, is I get distracted with too many other goals, and you just have to have that one goal in mind. So I guess our next speaker will be Amy. And a little info about her. She started her career as a product manager and now has grown her career in big tech ever since. She's a product manager. She has been a product manager at SAP, Netflix, and Google, and actually has offers to join all the other FANG companies. So that's awesome. And she's no stranger to job searching, from landing her first offer to negotiating her salary to increase by 100,000 every year. She was recently featured on Market Watch for being a master negotiator who is balancing career and her real estate side hustles. And she's been acquiring multiple properties since the age of 24. So Amy, go ahead. And I just wanted to say that if you haven't seen that Market Watch video, you should really go watch it. It's awesome.
Well, I was told that many of you are interested in learning about probably one, landing your dream job or your first job, and then negotiate, like, what do you do after you get that offer? How can you continue to both talk about compensation well and confidently, and then also negotiate once you start to get raises or get a promotion or switch jobs? How does negotiating that look like? So those are some of the things that I wanted to share today, in addition to obviously like goal setting and whatnot. This is also a big part of, I'm sure, your careers as well. Okay, so I just kind of wanted to go from just like the recruiting journey, maybe out of school. Some of you might be looking for internships in the next years, or also looking for your first full-time job out of school. And I think that for me, at least, similar to Max, I wasn't looking for jobs right when the financial crisis was happening, but I will say it was still a very tough time, because I think in college, a lot of us just have internship experience or club experience, and it's very hard to sometimes articulate to companies why they should hire a fresh grad over someone who's seasoned. So definitely want to go through some of those points, and from that stage all the way to after you get multiple offers, because I know you all work super hard and are overachievers and will have multiple offers. How do you handle discussing with your employer what you should be paid? All very uncomfortable conversations initially, but it's all about what you think you're worth. So a quick disclaimer, these tips have worked for me, but aren't always going to be guaranteed to work for you every time. And it also really depends on what industry you're in and what companies you're interviewing for. So for example, in finance, it's probably a little bit different from tech or a startup company, and things are different, negotiable based on what type of company you're working at. So just keep that in mind. Really depends on industry as well. First, I wanted to give a little bit of hope to all of you, because I think when I was recruiting out of school, so I went to Berkeley, and everybody was like hyper competitive about just about everything. And I was a business major, and I thought I was going to also do consulting like Max, but then I was like, maybe I'll try accounting, and then actually banking, and then ended up doing none of those. The lesson learned for me here is that you really only need one. And I personally felt that recruiting is really a numbers game sometimes. So don't settle per se, but definitely try to cast the net wide and see where you land. Like, shoot for the stars as well, because you never know, because you really only just need one person to take a chance on you. So for my personal experiences, I had a lot of, I tried like applying to all sorts of industries, and then also was like applying to the Googles and Facebooks of the world, but then ended up having a company, SAP, who took a chance on me, even though I had absolutely no product management experience, but they took a chance on me. And it really only took one to like make my career a product management career for the rest of the time that I've been working. So I've been a product manager ever since. And that's like really a big part of my life now. And I love the job. So I'm really glad that someone took a chance on me. And I think the lesson, or like the tip here, is to really just cast that net wide and see what happens. And don't get discouraged if, you know, out of the 100 applications, 99 of them reject you. You really only need one anyways. You can only have one job at a time. Well, I think you could do a side hustle, but that's separate. Another tip when in college, I think I remember even after college too, review your resume again and again, please, because what I noticed on the other end is that a lot of folks end up having typos or misformats when they send in their resume. And I think that a lot of times people just are afraid to ask others to read their resume or give tips and proofread for them. But it really is the best thing you can do for yourself, because this is the first thing and probably the only thing that recruiters will see when you put in that application. So please don't be shy asking a friend or asking a mentor or even someone in AIN to look at your resume before you submit that application, because you probably also use the same resume to send to that 100 employers, and those 100 employers will all spot that typo. So if you think there is a typo or grammatical error, it likely will also be noticed by someone else. So please just don't be shy about having your resume reviewed. And if you think you've reviewed it enough, you probably need to review it just at least one more time. Okay, so now that you passed the resume screen and you reviewed your resume 100 times and it was the perfect resume, the recruiter screen comes, and oftentimes you're going to be asked in the first call, in addition to like, why are you the best fit? The last question a recruiter might ask you is like, what is your expected compensation? And you're probably thinking, okay, this is the first call. How do I answer this? Because my expected compensation is that like you first hire me because that's all I want. I want the job. We can talk about compensation later. So the tips here, I would say, is try not to be the first one to throw out a number. You should do your research and know your market value even before this call, but I don't think you need to answer this question. So I have dodged this question personally many, many times. First, by generally saying like, oh, you know, we're very early in the conversation. Maybe perhaps as we get closer to actually getting more serious about our offer, then we can talk about compensation. Or I've also dodged this question by saying like, I haven't had enough time to do all the market research that I would like to and ensure that I want to give you an accurate number for my market value. So is it all right if we revisit this conversation later? Most of the time, actually like probably 10 out of 10 times, the recruiters have said, yep, no problem. And I like this because recruiters really do take very, very detailed notes. So if you anchor and say like, my expected compensation is like $50,000, but then later on throughout the process, you get like competing offers for like $75,000 a year, it becomes very hard to correct that, because imagine picking up the phone and telling the recruiter, oh, hey, actually, I know my expected compensation like 2 weeks ago was $50,000. I actually changed my mind. That is a really hard conversation to correct. So try to avoid just putting yourself in that situation by respectfully and like strategically avoiding this question and giving a number. Next, I guess here I should probably just add this up. I would practice responding this, because it is very hard when someone asks you a question, you generally want to answer the question, especially when you know you have the answer. So try to practice and mock this with a friend, a peer, mentor, anybody that you feel like could be comfortable just like practicing these canned answers, which is like, I would love to know what the range is. Ask them the question. Like in California, at least, it's I think it's by law, they have to disclose what the range is for the salary. So you can actually ask them what the range is that they are expecting for this role. And then you can be like, okay, great, with that information, like I'll reflect on it, but I don't have an expected like number yet. And then you can also dodge that question that way and delay the conversation later. So happy to share these slides later so that you can kind of look at the responses, but generally try to dodge that question early on. Tip number 2, try not to be the first one to throw out a number because you'd be surprised how much money you might be leaving on the table. They might have a range and they might tell you one thing, but there's always room for them to also move it up if they really want you. And by the time that they're giving you an offer, they probably really, really want you because they've spent many, many resources to try to get you to the stage of an offer. So ideally in the recruiter screen, don't be the first one to throw out that expected compensation number. And then at the time when they do give you an offer, try not to be the one to say like, I expect $100,000 a year. And then they were actually willing to give you $200,000, but you didn't know that. And now they're like, great, I saved $100,000. You probably don't want that to happen. Another thing here is do your research so that you know that they can potentially go up as high as whatever number that may be, so that if you were forced to throw out a number, at least you feel confident and comfortable with that number and that you're not leaving that much money on the table. But ideally, try to get them to go first. And also, I would say, at least in tech, don't always believe the first ranges that they give you. So I've had times when recruiters will say like, oh, the maximum for this level, for this role in your area is like $100,000 a year. And then somehow when the offer comes along, like the first offer they throw out is like $10,000 more than that. So you kind of wonder, like, at what point did they like, maybe they realized they really wanted someone or like you and decided to offer a little bit more, or it's a recruiting tactic. So you kind of have to try to see what game they're trying to play, because you're also playing this game as well. Okay, and then next one for me that's worked really, really well is getting more than one offer has helped me with negotiating. It's made it so much easier and so much more of a comfortable conversation, and not just that I am trying to get you to pay me more just because. It really anchors the conversation in market data and having a, I guess, common ground to talk about, more so than I feel like I deserve this, or they don't feel like you deserve this much. But instead, it's like, hey, based on what other companies are also paying me, I believe that is my worth. And so you, company A, should also match this or beat it if you really want me to join. So I think having leverage, this is really, honestly, this is like, doesn't just apply to job offers, but it also applies to in life. If you're ever negotiating anything, you should always try to have leverage, and having more than one offer gives you leverage to ask for more or to ask for a match with the other company. So I think this has just made me a lot more comfortable through the negotiating experience, because I always will try to get at least one more offer. Even if it's not higher, it's still a chance that I could decline someone else's offer and they might want to offer more. So, and even if you can't get an additional offer, because it is hard to get an offer, it still doesn't hurt to ask, but it must be backed by market data. So there's a lot of data out there like Glassdoor. In tech, we use something called levels, I think, that tells you general market ranges. So I think there's one for finance as well, maybe Blind or something, can give you some external data, and you can quote that to your recruiter. Okay, now we're getting close to like you have multiple offers and you've kind of decided which one you want to go with. You need to let them know that you're serious, the company that you want to sign with. You need to let them know that you're serious. So for instance, when I was interviewing with Google, I was still at SAP at the time, and I had an offer at Uber and Google, and I didn't know this tip, but essentially like both my recruiters came back, they went back and forth with me and increased my offer. And then finally, the Google recruiter, I had asked him, can you just increase my offer by like $5,000 more? And then that would make me feel better about this offer. And then he asked me, he was like, okay, well, Amy, if I went up to bat for you and got you this extra $5,000, would you sign? And I thought he was trapping me because I thought, oh, if I agree, then like there's no more room to negotiate. But then I realized later that's actually tactic where you're telling them like, hey, I'm serious about this, and I have basically chosen your company, and the only thing missing is this extra $5,000. But you must be actually serious that you will sign this because you've given them your word, and they are going to go up to bat for you because they know you're going to sign. So this is kind of your final card to be like, this is it. Like, I draw the line here and you draw the line here. If you do this for me, I will do this. I will sign this for you. So just know that this is like something you should play at the very end as your final like tactic. And then also find out what's negotiable at these companies, because I have not only talked about like just base salary, but there's equity involved. Sometimes you can get more shares, you can ask for more PTO, you can ask to be remote. Like, all of these are also negotiable too, depending on the company. So think about compensation, not just about salary, but just as the whole package. Okay, so now that you've signed, how do you prepare for asking for raises? If you're no longer thinking about just like your first company, but you're going through like your first job and you want a raise. Let's say you're like, oh man, I need to buy a car next year so that I don't have to commute on the BART or like a public transit. How am I going to do that without getting a raise? Make sure you plant the seed early with your manager and have career chats. You should do this anyways, not just for the money, but just for your career benefit. You should have career chats with your manager on a regular cadence. And then ask them early when performance reviews are so that they know you're thinking about performance reviews. And then when you know that the performance review is coming up, that's also when they're evaluating how much they should give you a raise, if anything. And at this point, you should now start planning backwards. So let's say they tell you performance reviews is in December. By October, you should have already planted a seed early that you are expecting an X% raise. In my first job, I did not do this. And so when I got my raise, I was told I was getting a 2.5% raise. And I'm pretty sure that is worse than inflation. So, or lower than inflation. So then I learned from that to always plant the seed early and set expectations so that you don't end up with a very, very sad raise. I think this is like one of the key learnings that I definitely would want everyone to know. Just always plant the seed early, and so your manager's thinking about it because you are thinking about it. And when you have this conversation, it's a little bit uncomfortable, but as long as you anchor it in data, I think that's been very helpful for me to get more comfortable with it, and always keeping things factual, data oriented, and then keep it anchored on your career and your market worth, because you can always go to a different company and you can always ask recruiters for information. You can share that with your manager. And I like keeping my manager a little bit on their toes because they probably don't keep a pulse on the market at all times, but you do. So you can share that with them as a learning experience. I also don't like, I wouldn't recommend being like, oh, I need to buy a car, so I need a raise. I like to anchor it on like things that are more important to like the job itself than personal circumstances on why you need a raise. So I don't recommend it. It's worked for some people. I personally wouldn't do that just because I don't like to get into my personal life with my manager too much. Okay, last point. If all else does not work and they continue to always give you 2% or 1% raises and call it a raise or a promotion, don't be afraid to switch jobs. This is actually what probably helped me accelerate a lot of my career by doing a diagonal hop every time I switched jobs. It not only elevated me in terms of experiences outside of one company, but I also got to learn a lot about different cultures, different products. And then I think that actually makes you a way better employee for future employers as well, because you have experiences from many different companies. This also accelerates, I think, your compensation a lot quicker than if you stayed at the same company for like 5-10 years. So something to consider if you're not happy or you need something else in your life.
Awesome. Thank you, Amy. Yeah, just a quick note. It really resonated with me when you said that you just need one. Yeah, going through sophomore year, summer recruiting, so many firms already done and a lot of rejections already, but that's okay. You just shoot for the stars and you land on the moon. So yeah. All right, thank you, Sam, Max, and Amy. And now we're just going to open it up to the question and answer section of this event. So we'll go for about 20 minutes. And If you want to unmute yourself or just put your question in the chat, I think Sam, Max, and Amy will be glad to answer your questions.
Sam, you had talked about doing your own due diligence for when you're doing investing and stuff like that. I currently work in real estate. A lot of my focus and learning has been surrounding completely on real estate. So I have a general understanding on how to do that kind of due diligence. But when it comes to like stocks and equities, I'm much less informed. I'm pretty kind of blank on most of that. How would you recommend being able to start learning on what kind of proper due diligence to do when it comes to like stocks and companies?
I think the first thing to do is to determine what kind of style you want to go for. There's many different strategies in investing in equities. So it kind of depends on you what you're most comfortable with or what you think is the best for your personal situation. For me personally, I focus on fundamental value and growth investing because I feel like that has the best track record over time. Like a lot of the most legendary investors with long track records, I'll use the style, like Warren Buffett, Peter Lynch, Fisher, and all the others. So because this style is proven, I'm a person who doesn't like to reinvent the wheel. I just want to go with best practices. There's two main styles of investing in equities, I think. One is called fundamental, one's called technical. Technical is basically like chart reading. You look at the charts and you try to predict the future based off of like certain movements and metrics. Fundamental is you dig into the valuations, the financial statements, and things like that. So there's a lot to analyze in both areas, but fundamental to me makes a lot of sense. Basically, if a company is performing well financially, then it should do well in its price over time. So to do that, I would learn to read financial statements in the quarterly reports and the annual reports. So there's a wealth of resources out there. It's on Investopedia. There's a lot on YouTube and so on. I try to look for the ones that will give you straight answers and tell you how to do it objectively. There's a number of metrics that you can look at. Those will also help narrow down your list. At the end of the day, there's two main things within fundamental investing. One's called a quantitative analysis, and one is qualitative. The quantitative is you look at the financial statements and you look for those metrics that you're going for. You calculate any sort of ratios to help you compare against their history, against the competitors, against the industry. Next up is the qualitative analysis. That's when you do a kind of judgment call based off of how you see the industry going, based off of your industry research, based off of your analysis of the sector and how it's performing relative to the economy. Is there a huge demand for this? For example, Blockbuster, the video rental company, was having a great financial year, but you can see that the writing's on a wall. Like it's not going to be around for much longer because qualitatively, you don't foresee a good future for it. You think that companies like Netflix or maybe in the future Disney, if you have a good enough crystal ball, are going to eventually overtake the sector. So even though the financials look good for that time period, qualitatively you disregard it for that reason. So you have to look at a variety of factors.
Thank you so much.
How do you think it is best to invest in out-of-state rental properties, and how do you reduce tax liability, and how do you look for houses virtually, and also getting a good property manager?
So I have one out-of-state rental, and how do you think it's best to start? Well, it depends on your experience levels, but I do think when out of state was actually my second property, so I understood at least how to like filter out realtors, and also had to learn how to filter out like better property managers. So I think first building out your team is really important. Make sure you talk to people who also invest in that market, and that will give you a good signal as to like, is this the right market for you? So for me, I think after picking the right market and having the team, from there, it was all about running numbers. I will say that for property managers, it just really requires a lot to look for good property managers. It is interviewing. So I called probably at least 10 property manager companies, and they were all referrals from the real estate association in that area. It's called the REIA group. So look for them, ask for referrals from them, and then start picking up the phone and calling and asking them the hard questions, like what happens if a tenant stops paying? Like when do you step in? At what point do you call me? And then how have you dealt with the situation in the past? So really getting like concrete examples from them and then asking all those hard questions was really helpful for me. Sam, if you have any other thoughts.
I think it all depends on your team on the ground over there, because realistically, you only have so much time to spend and you want to spend it efficiently. So you want to build a team of trusted professionals that you can rely on to help you with a lot of that legwork. Like Amy said, lots of interviewing will give you a baseline for who gives strong answers and who does not. And then you can choose to work with them. Referrals are also really strong. Like if you know someone who's done well and they have a referral to a certain area, then you can just kind of piggyback off of that, because a lot of the risk is taken out. Like someone you know has already done well.
Make sure to ask why that person referred the other person to, because I've also been screwed over with referrals as well. So like one of the realtors I used ended up getting fired after my transactions, and it was a referral as well. So I later learned that person was relatively new, but I trusted that referral like a little bit too much. So just make sure you talk to that person. As for tax liabilities, because I just saw the tax liability part, I think you're asking like, does out-of-state investing help with your tax liability? I assume you have a W-2 of some sort, but with long-term rentals, for example, passive income can only be written off. Passive losses can only write off passive gains. So it has to be like, for example, if you have another long-term rental that was making money, then you lost money due to depreciation or something on your other rental, then you can use those to offset each other. But it can't be used to offset your W-2 income, or maybe up to like $150,000 of your W-2 income. There's a lot of tax things there. So I'm not a CPA, but there are ways to use depreciation to reduce your tax liability.
I actually have a question for you, Amy, and this is more, I have two questions actually. First question I have is, your career as a product manager, what advice would you give someone if they wanted to go that route and they're already in their professional career? So for example, I'm currently I guess you would consider a program manager, but I'm titled as a contractor because I work for Meta, but I want to shift gears and go into product management. Like, what kind of advice would you give for someone who wants to shift gears?
I think the first thing is I realize a lot of people like misunderstand product management as well. So like make sure that you talk to a few different product managers, truly understand like what they do and then what makes them really good product managers. And then if you think that that's still a fit for you, I would actually start looking at product courses where you can actually learn the trait with other aspiring product managers taught by an actual product manager. So when I was actually at Early PM, I took a product school course. I don't necessarily recommend them, but there's a lot of like free product courses out there that you should actually take so that you're very familiar with the concepts of what you need to do to become a really good product manager. Then since you work at Meta or as a contractor at Meta, I would look at the rotational. I don't know if you all have rotational programs, but at Google we do, where we can offer like 10% of our time or 20% of our time to do a project with a product manager and actually demonstrate that you have these skill sets so that you can put it on your resume. And then once you're able to show that you've launched something from, even if it's like an internal tool or something super small, you can actually be able to use that example for your interviews so that people trust that you've had this experience. So it's really about like learning about the job, then getting a little bit of experience on it, and then framing that as like, hey, I've done this before. So you should take a chance on me because I've had experiences, even though my title doesn't say product manager. Does that help?
Oh, that's really interesting, because I think at Meta, there are certain groups that have rotational aspects to their contract, but I think ours doesn't. Maybe I should go and ask them. That's a good thing to think about.
Yeah.
The second part that I had a question about was pertaining to asking about an increase in your overall salary, like a raise, but I'm looking to ask for a raise for my entire team. Is that something you ever come across? Because I know there are challenges that my team has, but I want to be that voice for them.
I have never negotiated on behalf of a team before, but I suspect it's interesting because I think you said you're a contractor, right? So I've heard from my brother, who's also a software engineer, and he has actually gotten together with his team to all share their salaries and then realize that they all need a raise. I don't think that ended up that well for them. So I'm not sure how it just like, it seems like you're all banding to, like grouping together to like not, I don't know, like go against your employer. So I'm not sure if that's like the tone you want to set. There must be very like strategic ways to say this where you might, if you're the team lead or you're somehow like the manager, then like, yes, that makes sense. But these, I think my brother, they were all like IC engineers, individual contributing engineers. So it didn't look well. So maybe just thinking through the scenarios and how this would look if you were on the other side, and playing that out might be my best advice. But I don't know if Sam or Max, if you all have done this before, because I've never done that. Maybe Max, when you're at the startup, I don't know.
I think, Amy, it's, like that's it is a tough question. And the concept that you shared around doing the research, I think could help around, understanding the market value of an employee or whatever the team, each individual, the team kind of contributes and what the market value is for them. And then potentially bring that up as, hey, we're looking at numbers and we're looking at, metrics, and the team has worked hard. This is what they produced, having, prepared information, and then showing that, we maybe showing them, some of the additional evidence that, they're potentially being underpaid, or they deserve maybe a little bit more. That's all I can think of too.
I think I have an idea, because I think all the tips that Amy shared and your advice that you've given, probably give the same advice to my team and just kind of coach them through that kind of talk and see if they can come up with their own argument themselves.
Yeah, probably the best. Unless you're their manager, then maybe that is a good spot to come from.
Yeah, so I am their manager, but I also want to give them, I want to empower them to also be able to do that, because I'm not going to be their manager forever. Thank you.
Yep. And I think, Amy, we have another question for you in the chat. How do you handle recruiters when they tell you there's a time limit on accepting an offer? And Michelle says that she's been told that there's a 3 to 5 business days before the offer expires, which makes it difficult when you're kind of exploring multiple offers.
Yeah, that's always a tough one. The first thing is to, at the beginning of every, like when they first call you, I think they ask you like, oh, can I know your timeline? Be sure to share at that point that you are talking to multiple companies so that they know there's a lot of things in play. And then that's already subtly like they kind of understand, okay, they have to either be faster than everybody else or at the same time, like match around the same timeline, because they have different goals here, right? They want to get you beforehand, before other companies do. The other thing that when you do receive an offer, and let's say you're waiting for one more offer next week, I've also used the language of like, hey, look, I know that you want me to sign by Friday. However, I have mentioned to you that I am in the works with one other company, and I would like to finish what I started. They're like you probably wouldn't like it if I had gone through halfway with your round and just decided to like drop out. I would like to finish what I started. So if that's okay, if you could give me until like next Friday, when that final interview is already scheduled for next Wednesday, that I don't think that's unreasonable to ask. So I use the like, I like to finish what I started language. And then if they push even further, you kind of, there's 2 ways to go about this. Like you could say, well, if you had to make me make a decision by Friday, it's going to be a no. And that's kind of a risky card to play unless you are willing to let them go. For example, I have done this. I had an offer with Chime and they wanted me to sign by Friday. And then I was like, I'm waiting for Google and they're really slow. So it might be till next Friday or even longer. And I actually did say like, oh, I probably would turn you guys down because I don't have all my information in front of me and I can't make a good decision that way. It's not good for you and it's not good for me because I might turn around and renege on you guys. And that wouldn't be good either, right? So then the recruiter then asked the hiring manager if it's okay if I had more time because they're very strict with their 3-day deadline. But then the hiring manager was like, oh no, take the weekend, take like a little bit more time if you need it, because I would really rather not lose you just because you don't have all the information. So it has worked, and it depends on like what scenario, like how the market is, and if they have another candidate waiting. But try to use that language, and if not, fake sick that you would do the final round later, because that's on you, right? You could have moved the interviews as well to make sure it lines up. So I've done all of those things, and some of them have worked out depending on like how much they need you.
I definitely wanted to ask Max more on the networking side. And how do you make it less transactional and more, like you said, developing an actual relationship with the person that you're trying to, get to know, especially, at the beginning, there's seemingly no shared interest. What's the best advice on like how to frame that cold email or, that first outreach?
Yeah, no, it's a good question. And it is really tough. It's hard to kind of put yourself out there a lot of times. The way I see it is there's really kind of like two different types of ways with like networking and making friends, right? That worked for me. So I've made actually a lot of friends at the Career Center when I was going to UCI. One of my biggest mentors at the time, I met him through the Career Center. He was interning at Deloitte, then he eventually got full-time at Deloitte. And that was like, at that time, I was like, dang, this is like, if I could be like you, then that'd be great. And he helped me so much. Like he like was the first person to ever review my resume. He gave me like a bunch of interview tips. And we had also like a lot of shared interests. And this is what I mean by like having kind of like friends who are also kind of like your network. Like we played Magic the Gathering together, and eventually when he was interning at like Deloitte and I was, I think, a sophomore, junior, freshman year, he would like come back to the Bay Area on certain weekends and we would just play Magic, and really, I think to build like a very organic relationship with people that have shared interests is helpful. And that could be like a career shared interest too. If like I've made friends where we all have been like doing like the same interview process for the same company at like Career Center, and we would like hang out together and like talk about like the case studies and stuff like that. And then you find out more about those people and you have other shared interests. So the way that's one way that I've done it. And then I've even like had friends and who were not part of like a professional circle per se, like my old roommate who introduced me to like somebody who was looking to do a startup back in 2009. And I think for those are just, they just tend to be pretty organic. But when you're in that social environment and you're talking to people daily, they know what's going on. I think it's important to stay close to your friends, make sure that you can help them, they can help you too, wherever there's that opportunity. But I'd say those are probably like the two areas that I leverage the most.
Part of networking and making friends with people professionally is just showing up. Like a lot of times we feel like a lack of motivation, like or lazy, or like it's too much work or something like that. But just showing up, a lot of times like you get the relationship started, and you never know how it will turn out. Like for example, Amy and I met on a hike several years ago. We had no idea that we would ever be working together on AIN. It didn't even exist at the time. We were just on a hike and we had great chat and we kept in touch over the years. And then now just earlier this year, we started working together on AIN. So you never know how things will turn out. Sometimes you plant the seeds many years ago and then it sprouts into something cool.
So yeah, thank you everyone for being here. Thank you, Max and Amy and Sam for talking through a lot of the tips. I definitely like the talking about how to dodge the expected comp question for sure, and just all the characteristics of personal finance through Sam, and then just sticking to your game plan and what Max talked about too as well. So really great for everyone to come on a Saturday evening. And yeah, that concludes the intro to personal finance. Thank you all for coming. Hope you enjoyed the session.
Thank you.
Thank you, everyone.
Awesome. Thanks, everyone. Thanks,
Thanks,
Sam. Thanks,
everyone.
Henry. Thanks, Amy.
Thank you.
Thank you for joining us today. If you'd like to stay up to date with us in the future, please subscribe to our YouTube channel, visit our website, and join our Facebook group.